China's real estate collapse, a $1.5 trillion market shakeup and its global repercussions. Introduction. China's real estate sector is in the grip of a monumental crisis which has been evolving since 2021, leading to a market shakeup estimated at $1.5 trillion. This upheaval has not only affected the domestic economy but also posed significant risks to global financial stability. The crisis began with the financial troubles of Evergrande Group, a developer that defaulted on its debts due to a combination of over-leveraging and stringent government policies aimed at curbing real estate speculation. The fallout from this crisis has highlighted systemic issues within the Chinese real estate market and has had ripple effects across the globe. Background. The Chinese real estate market, which has been a driving force behind the country's economic growth for decades, began showing signs of trouble as early as 2020. In an effort to rein in rampant speculation, the Chinese government introduced the Three Red Lines policy, which imposed limits on the amount of debt property developers could incur based on their financial metrics. Evergrande, already heavily indebted, quickly violated these limits, leading to a liquidity crisis. Timeline of key events. Pre-crisis period. 2020, the Chinese government introduces the Three Red Lines policy restricting how much debt developers can take on. 2021, Evergrande warns of severe cash flow problems in August, leading to a dramatic decline in its stock price. The crisis unfolds. December 2021, Evergrande defaults on its first offshore bond with liabilities exceeding $300 billion. This marks the official onset of the crisis. 2022 to 2023, a significant number of homebuyers begin boycotting mortgage payments, leading to halted construction and an inventory crisis. Estimates indicate that between 60 to 80 million apartments remain unsold in China. August 2023, Evergrande files for bankruptcy protection in the U.S. as its chairman is detained for alleged illegal activities. January 2024, a Hong Kong court orders the liquidation of Evergrande due to its failure to present a viable restructuring plan. Country Garden, another major developer, warns of significant losses and potential defaults. Government response and market stabilization efforts. Late 2024, early 2025, the Chinese government takes more assertive measures to stabilize the market, including financial support for developers and initiatives to promote affordable housing. Structural issues in the real estate market. Over-leveraging and debt. China's real estate sector has long been characterized by excessive borrowing. Prior to the crisis, real estate accounted for approximately 45% of all financing within China's financial system. Developers like Evergrande accumulated vast debts in pursuit of aggressive expansion, which left them vulnerable to market fluctuations. The introduction of the Three Red Lines policy exposed the unsustainable nature of their financial practices. Government regulations. The Chinese government's attempts to stabilize the real estate market have included various regulatory measures such as limits on mortgage lending, rent caps in major cities, and a proposed nationwide property tax. These measures were designed to curb speculation but inadvertently contributed to a slowdown in the housing market, ultimately leading to reduced sales and a rise in unsold properties. Global impact. The repercussions of China's real estate crisis extend beyond its borders. As one of the largest economies in the world, China's financial health is intertwined with global markets. The default of Evergrande and the challenges faced by other developers have raised concerns among foreign investors and financial institutions with exposure to Chinese real estate. Financial contagion. The interconnectedness of global financial systems means that a crisis in China can lead to broader market instability. Reports of significant exposure to Evergrande by American and European firms illustrate the potential for financial contagion. As confidence in the Chinese economy wanes, foreign investments are likely to decline, impacting global economic growth. Diverging perspectives. Optimistic views. Some analysts maintain a more optimistic outlook, arguing that the market could stabilize by 2025. They propose that government interventions such as purchasing unsold homes and providing financial support to developers could alleviate the crisis and lead to a recovery. Pessimistic views. Conversely, others highlight the ongoing instability and the risk of a prolonged downturn. They emphasize that the real estate sector's collapse is indicative of deeper structural issues within the Chinese economy which could take years to resolve. Conclusion: China's real estate market is undergoing a critical adjustment with far-reaching implications for both its economy and the global financial landscape. The combination of high debt levels, regulatory challenges, and the need for substantial government intervention underscores the complexity of the situation. While some analysts predict a recovery by 2025, significant uncertainties remain as the impacts of this $1.5 trillion crisis continue to unfold. The path forward will depend not only on the effectiveness of government policies but also on the resilience of the global economy in the face of these challenges. The content presents a complex narrative about China's real estate crisis, highlighting critical issues and counterintuitive perspectives that emerge from the analysis. Here are some of the key counterintuitive points. 1. Comparison with other financial crises. A primary counterintuitive point is the argument against equating China's real estate crisis with the U.S. subprime mortgage crisis or Japan's prolonged stagnation. While many observers draw parallels, the argument presented suggests that the structural conditions in China do not allow for a similar contagion effect. For instance, China's government has historically maintained stricter lending practices compared to the U.S. during the subprime crisis, where zero down payments were commonplace, contributing to the financial bubble. This highlights the notion that despite the severity of the Chinese crisis, the systemic risks may not lead to a global financial collapse akin to that seen in the West. 2. Government intervention and economic stability. Another counterintuitive aspect is the belief that aggressive government intervention, often seen as a reaction to crisis, can be a stabilizing force for the economy. While it is widely accepted that government intervention can sometimes exacerbate market problems, the argument here posits that in China's case, the state's financial support for developers and initiatives for affordable housing could lead to a recovery. This suggests that proactive measures can effectively address the excess inventory and restore confidence in the market. 3. Perception of declining housing prices. The expectation that declining housing prices are inherently negative is challenged. While conventional wisdom suggests that falling prices indicate a failing market, the analysis points out that the reduction of housing prices relative to income can actually improve affordability. This perspective indicates that a recalibration of prices may benefit long-term market health by making homeownership more attainable for a larger segment of the population. 4. Impact of urbanization rates. The urbanization rate in China is highlighted as a critical factor that distinguishes its current crisis from Japan's past experiences. The argument posits that because China's urbanization is still underway, there remains potential demand for housing. This counters the narrative that the market is doomed to stagnation. Instead, it suggests a latent growth opportunity that policymakers can leverage. 5. Number of real estate companies. The sheer number of real estate companies in China, over 90,000, is presented as a double-edged sword. While this might suggest an oversaturated market, it also highlights the potential for consolidation and restructuring within the industry. The implication is that the crisis could lead to a healthier market composition as weaker firms are pushed out, allowing stronger players to thrive. 6. Debt management. The notion that China's high levels of developer debt are a liability is nuanced by the argument that the debt is localized and not intertwined with broader financial markets. This localized risk implies that while bankruptcies may occur, they will not necessarily lead to widespread financial contagion, countering the fears typically associated with high corporate debt levels. 7. Public perception and investor confidence. The relationship between public sentiment and market stability is complex. The idea that homebuyer boycotts of mortgage payments could lead to a further decline in confidence is countered by the perspective that these actions may pressure the government to act more decisively in addressing the crisis. Thus, what may initially appear detrimental could lead to necessary reforms. 8. Optimism about future recovery. The expectation of a recovery by 2025 contrasts sharply with more pessimistic views on the trajectory of the Chinese economy. This optimism, rooted in the belief that the underlying demand for housing will eventually outstrip supply, suggests that the current crisis may be viewed as a necessary correction rather than an irreversible downturn. In summary, the analysis of China's real estate crisis presents several counterintuitive themes which challenge conventional wisdom about financial crises, government intervention, and market dynamics. These insights suggest a more nuanced understanding of the situation, emphasizing potential pathways to recovery and stability that might not align with typical crisis narratives. China's real estate collapse has been a significant event with repercussions that extend beyond its borders. While many observers focus on the immediate financial implications and the potential for economic instability within China, there are several important aspects of this crisis that are likely to be overlooked but are highly significant. Here are key elements that deserve more attention. 1. The psychological impact on consumers and investors. The psychological effects of the real estate crisis on Chinese consumers and investors could have long-lasting effects on the Chinese economy. The collapse of major developers like Evergrande has not only led to financial losses but also eroded trust in property investments. Homebuyers who have invested their life savings into unfinished homes are now facing uncertainty. This can lead to a broader reluctance to invest in real estate or consume goods and services, potentially stalling economic recovery. The fear of further defaults and economic instability may lead consumers to adopt a more cautious financial posture, negatively impacting consumer spending. Significance: the psychological impact could contribute to a prolonged period of economic stagnation, as consumer confidence is crucial for economic recovery. If consumers do not spend, businesses will struggle, potentially leading to a cycle of further economic decline. 2. The ripple effect on local governments. Local governments in China have relied heavily on land sales for revenue, which has been significantly affected by the real estate collapse. The drop in land prices and the reduction in land sales revenue mean that local governments may face severe budget shortfalls. This could lead to cuts in public services, infrastructure projects, and social programs, which in turn could exacerbate social discontent. Significance: the financial health of local governments is intrinsically linked to social stability. If local governments cannot meet public expectations due to revenue shortfalls, it could lead to protests or unrest, undermining the stability that the Chinese government seeks to maintain. 3. Potential for broader financial contagion. While many analysts have drawn parallels between the Chinese real estate crisis and the 2008 U.S. subprime mortgage crisis, the unique structure of China's financial system means that contagion could manifest differently. The crisis has already affected various sectors, including shadow banking and wealth management products. The interconnectedness of financial institutions and developers means that the fallout could create a broader financial crisis if not managed. Significance: the risk of financial contagion is significant because it could lead to a systemic crisis that affects banks and other financial institutions, not just real estate developers. This could have global implications, particularly for investors with exposure to Chinese markets. 4. Government's role in market stabilization. The Chinese government's response to the real estate crisis is critical. Yet the effectiveness of its interventions remains uncertain. The government's measures to stabilize the housing market, such as purchasing unsold homes and providing loans to developers, might not be sufficient to restore confidence. Additionally, the extent to which the government will be willing to bail out failing corporations remains a contentious issue. Significance: the government's approach will not only impact the real estate sector but could set a precedent for how it deals with future economic crises. An overly aggressive bailout could encourage moral hazard, while a hands-off approach might lead to deeper systemic risks. 5. Impact on global supply chains. The real estate crisis could have implications for global supply chains, especially in industries reliant on construction and real estate development. Companies involved in manufacturing building materials, machinery, and other related industries may experience reduced demand as construction projects are halted or cancelled. Significance: a slowdown in demand from one of the world's largest economies could disrupt global supply chains and affect companies and economies that are dependent on Chinese manufacturing. This could lead to inflationary pressures and further complicate global economic recovery efforts. 6. Shift in investment patterns. As domestic investment in real estate becomes riskier, capital may flow into alternative investments such as technology or green energy sectors. However, the overall investment climate may become more volatile as investors seek safer assets amid uncertainty. This could lead to underinvestment in critical sectors that require capital for innovation and growth. Significance: the shift in investment patterns can reshape the Chinese economy. While it may lead to growth in new industries, it could also result in a neglect of traditional sectors that remain crucial for overall economic health. 7. Socio-economic inequality. The fallout from the real estate crisis could exacerbate socio-economic inequalities in China. Homeowners who invested heavily in properties that are now worthless face financial ruin, while those who could not afford to buy homes may see an opportunity to enter the market as prices drop. However, access to affordable housing remains a significant issue, particularly in urban areas where demand far exceeds supply. Significance: growing inequality could lead to social tensions and dissatisfaction with the government, which may lead to political challenges. Addressing these inequalities will be crucial for maintaining social stability. 8. Long-term urbanization trends. China's urbanization rate is still evolving. The real estate collapse may slow urbanization as housing becomes less affordable or accessible. This can impact labor markets, productivity, and economic growth, as urban areas typically drive innovation and economic activity. Significance: the impact on urbanization trends can affect China's economic strategy moving forward. A slowdown in urbanization could lead to greater rural-urban divides and hinder efforts to modernize the economy. Conclusion: the implications of China's real estate collapse extend far beyond immediate financial losses. The psychological impact on consumers, the financial health of local governments, the potential for contagion in financial markets, and the effects on global supply chains and socio-economic inequality are just a few areas that warrant deeper analysis. Understanding these facets is crucial for assessing the full scope of the crisis and its potential long-term effects on both China and the global economy. Addressing these challenges effectively will be key to stabilizing not only China's economy but also maintaining confidence in global financial markets. 1. Structural issues and overleveraging. The Chinese real estate crisis is largely attributed to systemic structural issues, particularly the excessive debt levels and overleveraging of prominent developers like Evergrande. The introduction of the Three Red Lines policy in 2020 aimed to curb this overleveraging by imposing strict borrowing limits based on financial metrics. However, many developers, including Evergrande, failed to adhere to these limits, leading to a liquidity crisis and subsequent defaults. The crisis is exacerbated by the real estate sector's importance to China's economy, as it constitutes a significant portion of local government revenue and employment. The implications of these structural issues extend beyond China, highlighting vulnerabilities in the global financial system due to the interconnectedness of economies. 2. Government intervention and policy responses. The Chinese government's response to the crisis has included significant intervention measures aimed at stabilizing the real estate market. These measures include financial support for developers purchasing unsold inventory and promoting affordable housing initiatives. The government has also explored regulatory adjustments such as easing mortgage lending limits to stimulate demand. While some analysts predict a stabilization by 2025, the effectiveness of these interventions remains uncertain. This situation raises questions about the balance between market forces and government intervention in addressing economic crises and the long-term sustainability of such approaches. 3. Global repercussions and financial contagion. The fallout from China's real estate crisis has potential global repercussions, particularly for foreign investors and markets. The interconnectedness of financial systems means that defaults by major Chinese developers can trigger broader financial instability affecting global markets and investor confidence. The exposure of Western financial institutions to Chinese real estate debt, primarily through corporate bonds, highlights the risk of financial contagion. This situation underscores the importance of monitoring systemic risks in emerging markets and the potential for localized crises to escalate into global financial challenges. 4. Comparative analyses and future outlook. The ongoing debate regarding the comparison of China's real estate crisis to historical events such as the U.S. subprime mortgage crisis and Japan's lost decades reveals differing perspectives among analysts. While some argue that the structural differences between these crises suggest that China may avoid a similar fate, others caution against complacency, pointing to potential long-term economic stagnation and persistent debt issues. The outlook for China's real estate market remains uncertain, with predictions of stabilization by 2025 juxtaposed against the possibility of prolonged downturns and defaults among major developers. The resolution of these challenges may require a re-evaluation of economic policies and a commitment to sustainable growth practices in the future. 1. U.S. subprime mortgage crisis 2007 to 2008. The subprime mortgage crisis in the United States was a significant financial crisis that resulted from a dramatic rise in mortgage delinquencies and foreclosures, particularly among borrowers with poor credit histories. The crisis was rooted in the housing bubble that peaked in 2006 when home prices soared, leading to a high volume of risky mortgage lending practices. Financial institutions had bundled these risky loans into mortgage-backed securities, spreading the risk throughout the global financial system. The collapse of major financial institutions such as Lehman Brothers and the subsequent government bailouts highlighted the interconnectedness of global finance and the catastrophic impact of real estate market failures. 2. Japanese asset price bubble 1986 to 1991. In the late 1980s, Japan experienced a significant asset price bubble driven by speculation in real estate and stock markets. The Bank of Japan's loose monetary policy contributed to soaring property values, which resulted in a speculative frenzy. When the bubble burst in 1991, property prices plummeted, leading to a prolonged economic stagnation known as the lost decade. The collapse of the real estate market severely impacted Japanese banks, which were left with massive non-performing loans. The effects of this crisis persisted for years, fundamentally altering Japan's economy and leading to significant changes in its financial regulation. 3. Icelandic financial crisis 2008. The Icelandic financial crisis was precipitated by the collapse of major banks due to excessive speculation and over-leverage in the real estate and financial sectors. In the years leading up to the crisis, Iceland's banks expanded rapidly, offering high-interest loans and engaging in risky investments. When the global financial crisis hit in 2008, the value of the Icelandic krona plummeted and the banks, unable to secure funding, collapsed. The Icelandic government intervened, nationalizing the banks and implementing capital controls. The crisis severely affected the real estate market, leading to widespread foreclosures and a deep recession. It also prompted significant reforms in Iceland's financial regulations and oversight to prevent similar future crises. Future outlook: predictions for China's real estate sector and its global impact. As we look towards the future in 2025 and beyond, the trajectory of China's real estate market remains a crucial area of focus. The current crisis, which has led to a significant shakeup estimated at $1.5 trillion, is expected to evolve in various ways, influencing both the domestic economy and global markets. Stabilization and recovery by 2025. 1. Market stabilization. Analysts predict that by 2025 China's real estate market will stabilize, primarily driven by government intervention and reforms. The Chinese government has already initiated multiple measures to address the overcapacity and high debt levels among real estate developers. These include substantial financial support for struggling developers and a push for affordable housing initiatives. 2. Government interventions. The government's allocation of trillions of yuan to purchase unsold inventory and finance affordable housing will likely mitigate the immediate impacts of the real estate collapse. The aim is to convert unsold properties into public housing, which will not only help alleviate the housing crisis but also restore confidence among homebuyers and investors. 3. Long-term housing affordability. With housing prices having plummeted by 40 to 50% from their peaks, the affordability ratio is expected to improve significantly. By 2025, it is projected that housing prices will align more closely with household incomes, potentially reducing the time required for families to purchase homes from 20 to 30 years to a more reasonable 8 to 15 years. Economic growth and structural reform. 1. Broader economic impact. The stabilization of the real estate market is anticipated to contribute positively to China's overall economic growth. With real estate accounting for a significant portion of the Chinese economy, a recovery in this sector could lead to a rebound in related industries such as construction, manufacturing, and retail. 2. Shift in financial practices. The crisis has exposed the unsustainable debt practices prevalent in the real estate sector. Moving forward, it is expected that stricter regulations will be implemented, limiting debt levels for developers and promoting healthier financial practices. This will prepare the ground for a more resilient economy that is less reliant on speculative real estate investments. 3. Increased focus on urbanization. China's ongoing urbanization, with significant rural to urban migration projected over the next 2 decades, will drive demand for housing. As the urbanization rate increases, there will be a corresponding need for affordable housing solutions, which the government is likely to prioritize. Global repercussions. 1. Global market sensitivity. The interconnectedness of global markets means that the fallout from China's real estate crisis has already been felt worldwide. While the immediate risks of contagion may recede as the market stabilizes, any significant fluctuations in the Chinese economy could still provoke reactions in global financial markets, especially among investors heavily exposed to Chinese bonds and equities. 2. Investment shifts. As China stabilizes its real estate market, foreign investments may gradually return. However, investors are likely to approach with caution, favoring more transparency and regulatory clarity in the Chinese market. This could lead to a reshuffling of capital flows, where investors diversify their portfolios to mitigate risks associated with potential future crises. 3. Impact on commodities. A recovery in the Chinese real estate market will likely boost demand for commodities such as steel, cement, and other construction materials, which could lead to upward pressure on global commodity prices. This in turn could impact inflation rates and economic policies in other countries. Conclusion. The outlook for China's real estate market post-crisis is one of cautious optimism. While challenges remain, the combination of government intervention, structural reforms, and the potential for a renewed focus on housing affordability positions the market for recovery by 2025. The global repercussions of this recovery will be significant, influencing investment strategies, global markets, and commodity prices as China navigates this critical juncture. Its ability to stabilize its real estate sector will play a pivotal role in shaping both its economic future and that of the global economy.